I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now shortages or have been abated. So you see that in the housing services sector, we expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently. And I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation. Quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say We still think there's work to do there. We haven't made a decision on exactly where that will be. I think, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage, whereas of course we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down. This is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods the core services ex-housing sector that I talked about. we don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is. Research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps we'll see more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above-target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the 3 things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right by an appropriate set of measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
Well, you'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
yes,
you're, okay.
Yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilek from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now.
So we're just picking up a short trade here on Meta, 152.21, 152.21 short on Meta, 1/6 position. So we pierced through that gap in an extended move. The next ad level on Meta is 152.99.
So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect.
SPY's remaining strong.
Possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors. And,
So Meta's coming in.
So sectors that represent 55 or 60% of that.
We're going to look for $1 on Meta per share. $1 on Meta.
We think are sensitive to
Bloomberg Markets is brought to you in part by Desjardins. Help your clients make investments that can make
labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require. terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down.
So we are short Meta right now.
Market. I think most forecasters would say that
I've also got AMD on the radar.
Rise a bit from here, but I still
I
think
want AMD to push up to
there's a
84,
path to
58.
getting inflation back down to 2% without a really significant economic decline or a significant increase.
Slightly in the money on Meta.
And that's because the setting we're in is quite different. The inflation that
Our
we
oil trade is still
originally
trying to
got
bounce.
was very much a collision between
Markets are coming in from the highs,
very
and
strong
honestly,
demand
for
and
Fed day,
hard
Fed meeting, the
supply.
volume
It's not something
has
that you
upticked, but it's really not that impressive.
in prior business cycles. And so now we see goods inflation coming down for the reasons we thought. And
But markets are still remaining strong. Yields have dropped. The dollar's dropped. The 2-year is now at 4.11, so this is the largest discrepancy between the Fed fund rate and the 2-year yield.
We don't yet see weakening in the labor market, so we'll have to see.
Typically, as we enter the disinflationary process where yields drop, that actually is, in most scenarios, bad for stocks. But we've been hearing the White House saying that we've achieved a soft landing, which I don't believe.
It may well be.
But I could be wrong. We'll have to respect the price action as it comes.
Slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that
Another short I'm watching is Peloton. I do want it a little bit higher though.
without a really significant downturn.
1621 is a great level on Peloton,
That's a possible outcome.
but I'm gonna see if we can get it a tiny bit higher,
It's not the most likely outcome, but I would say there's
around a Pierce of 17. I may miss the trade, but that's okay. Markets are trying to push back up now.
Substantial downturn, and ask with the full weight of your tightening not in place yet, and
Tesla's now trading the most volume, up
against inflation, there's still
3.31%.
very, very slow growth going forward in
Let's look at the Tesla chart.
and the
Tesla's
recession
coming up into
indicators
this
are all suggesting,
double top zone.
we are going to see recession this year. So I'm wondering if
Big,
you've
big
changed
level in the
your
markets.
view, or you have a
Big,
more
big
nuanced
level.
view of what you think
And then if we look at the
danger
SPY,
to, economic growth
still
is
pushing
going
near the
forward,
highs.
and whether you're very
We'll
close
flip back to
to
Meta.
perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Walters suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence
So
metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down. And Congress did what it did, and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great. But we just see that it has to spread through the economy, and that it's going to take some time. That's all.
So we're going to add to our meta trade here if it continues to push up.
In labor market conditions and inflation moving down steadily, but not quickly. And in that case,
152.99 or Pierce on Meta. Tesla's pushing high of day. Nvidia's volume remains fairly light for this type of event.
Inflation coming down much faster, that's a different thing. If that happens, if inflation comes down
so far from the highs to the lows, the S&P has now rallied 2%, 2% to the upside. And keep in mind, it has been rallying throughout most of January as well, having the best January since 2001.
Outcome.
That is creeping up a little bit more now.
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession. and we have inflation moving down, into the somewhere in the mid threes or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if we get if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Up now 5%, a little bit of squeeze. Get ready to add to Meta here. I'm gonna let it pierce this level, 153.01, 153.01. That's a 2-6 position on Meta. It's still squeezing. It's still squeezing. Spiders are up now 2.27. 153.01 was the next add level. So the spiders are continuing to push near the highs of the chart. Meta's trying to pull off. Our average here on Meta is 152.64 short.
If you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively, in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day. The more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are. We pick that up in conversations, and I've seen some data too that show people are, gradually they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low, with 3.5% unemployment and high wage increases nominally by historical standards. Why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses. Essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully. As the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
That wraps up the news conference with Chairman Powell, a balanced Fed Chair, Jay Powell. I can tell you, the market screaming one thing, and that's we've got our own view on this. Equities look like this on the S&P 500. Good afternoon to you.
So we're seeing Meta sell off a little bit. We're still going to try to go for $1. The S&P is coming off the highs. So Meta's coming in now. The markets are coming in. This is the first real sign of sell pressure coming in. They pumped the markets up. Will they reverse them? It's a big if, but it was light volume, this rally. So it certainly can potentially see some downside. We're still going for $1 on Meta.
News statement, up we go, no big deal. We said maybe the presser will be there, and the presser for a number of minutes was as expected, and then maybe like I've never seen. It's not that we're up, John, it's the way we're up. Out there right now is a massive short cover into some form
Dollar's
of
catching a little bit of a bid.
Just got a message on the Bloomberg. I won't reveal who it is until they give me permission to do so.
Meta's coming in more now. Get ready to cover
This
Meta.
is what happens when you don't validate the December dots.
We're going to get our dollar
That's the
here
view out there
if
on
it
Wall
comes
Street
in a
at the
little bit
moment.
more.
I'll go one step further.
So we're still watching Meta. Pretty much everything is coming in. The S&P still remains strong, though it did make a new high in the spectacular rally that it's had. So get ready on Meta. We do have a big earnings. We have Meta, Merck, Aflac, a whole bunch of big names that should indicate a whole bunch of direction in the macroeconomic landscape. But once again, you've seen meme coins, Carvana, or stocks fly. You saw the gambling stocks this morning.
Somebody count how many times he said disinflation. John, I actually was thinking, and folks, I can't convey enough the velocities of the market. here speaking, price up, yield down. John, the 2-year yield to 4 digits at one brief second, 4.0981. I was thinking to myself, is this guy going to drive the 2-year under 4% by the end of the conference? If McKeon has 3 follow-ups, we may have gotten there.
Hey, earlier on this week, we asked, what are you more interested in, the words of Chairman Powell or the economic data? Based on that performance, I'd rather hear from the economic data. Wouldn't you, Lisa?
I mean, basically...
And the markets have sold off a little bit from the high, but they're getting bought right back up.
And cautiously optimistic. The idea that he's still talking about a soft landing really highlights just this, saying that, yeah, maybe the balance of risks, hem ha. You've got concerns about perhaps not going far enough, but things look pretty good. Again, this isn't the pushback that people are going to look for in the market.
I like that question on the balance of risk. It came from Colby over at the Financial Times, I think. Colby Smith. Do you remember Colby?
Yeah, I remember. Yeah.
Used to be the class of surveillance so many years ago.
Really?
She asked about the balance of risk, and he kind of danced around it. Maybe 4 months ago, he would have said the risk of doing too little outweighs the risk of doing too much. And then he sort of ummed and ahed. Very difficult to manage the risk of doing too little. And obviously, if we do too much, we can do something. But it lacked any real conviction, didn't it?
Okay, so
We're still holding boil overnight with our natural gas.
Because if he does mean what he says, why didn't he go 50 and then just pause, right? I mean, in other words, if he really is concerned about financial conditions in any level, then why didn't he do that? And really, that is the screaming conclusion after this press conference.
I'm looking at 2.05% NASDAQ lift. You know, the Dow not playing. SPX, I think, is playing out. The new high's 41.18. And I'm thinking of corporations going, okay, we need to buy back shares. And the CEO's on the phone right now screaming, why didn't we do this last Wednesday? Again, folks, you don't see this. It's the red and green of the Bloomberg screen, and John's is different than mine, Lisa's is different than John's, etc. The pulsing here of the bet, John, is tangible.
There is clearly still a massive spread between the projections and the dot plot from the last summary of economic projections and what this market is priced for. And that's going to be resolved in the next couple of months, potentially to some extent, by the incoming information and the data, not by the Fed speak. Let's wait for the data, the CPI prints and the labour market data, and it starts with payrolls tomorrow.
So here's my
Right now,
question.
Manus is
If you get an
hovering.
easy...
We take a look at the SPY. It's trying to float back up. You had your initial pop off the FOMC. This is good daily resistance on pretty much all the charts. So we'll just flip through. You can see it's trading at the top end of the range into these pivots. Can it confirm above these pivots? You'll likely trigger many people on the buy side. So Meta's trying to push back up with the market. Another short trade that I'm looking at is Spotify. Spotify is looking very appealing. SPOT is the ticker. Spotify has had a tremendous run recently. So Meta is still seeing a little bit of downside as the SPY comes in slightly. We can still potentially look for $1 on Meta. There is earnings after the bell. Obviously we are short Meta on a swing, so hopefully they don't do too well on their earnings. But again, anything can happen on an earnings day. In terms of other setups that we're looking for, we also have Merck coming after the bell, which has seen some downside in recent sessions. So it has sold off heading into earnings, but that could be potentially a little indication that maybe it is going to be a weak earnings report, or at least weak guidance. So it'll be interesting to see if we can see some more downside. And in terms of Meta, we're just still waiting on Meta patiently. I'm trying to see if there's any other opportunities We have the likes of Carvana that's up 38% now. So let me see if I can isolate a level on Carvana. This thing is just going crazy. Truly is. It's up 38%. You also have Peloton up 25. That one hasn't really moved up over the highs, but Carvana is just a beast. So Carvana is actually coming into our first short level. Our first short level would actually just tagged that by a penny. 1433 was the level. Wow. Another one missed. I have it on my other chart here, 1433, but it's still good if it hits this 1438. I'm going to watch Meta on my other chart. It's still good if we can short Carvana at 1438. I'll raise my level since it's tagged at 33 level. But Carvana is coming in, putting in a little bit of a potential topping tail. We'll see what transpires. Take a look at this move, impressive move in Spotify. Astounding move off of earnings. Truly is. Nvidia's up 7.2. Boeing's actually seen an inflow of volume, but it's pulling off of the highs, so showing a little bit of relative weakness compared to the market strength. Now Carvana's coming back up again. Carvana is coming back up, so keep that on the radar. But this is a short squeeze candidate, so it's super, super duper high risk. So Meta's seeing a little bit of weakness as the SPY is continuing to try to get bought back up. Can we see Meta fall? If we get a little bit of weakness in the SPY, we should. Right now Carvana's pushing up, so keep Carvana up on your other screen. Actually, I'll keep it up here for you guys. Market's acting strong, so again, this is super high risk, but I may wait now to these next upper range levels. We'll see. I'm gonna play it candle by candle here on Carvana. I'm watching Meta, it's coming in. Carvana's at 1410, 1420 now, it's pushing up. Spiders are still off of the highs just slightly. The volume hasn't picked up that much. Keep Meta. We're almost going to see some downside action in Meta. But the dollar has seen 1, 2, 3, 4, 5, 6, 7, 8, 9 4-hour downside candles in a row. 9 consecutive 4-hour candles in the dollar. And believe it or not, it does still favor a potential bounce at some point with this type of price action. It's extremely oversold. Markets are even more overbought after today, especially in a lot of the small cap stocks. Flip back to Meta since Carvana is pulling off of that high. It's just floating at this level. We have about 30 minutes left to the end of the market session, and the SPY is trying to catch a bid. Nvidia is near the highs. Let's take a look at AMD. AMD's been leading the market all day. AMD isn't to my short level, but it's a tough environment to short right now. It really is because of the volume is so light. But this is a pure short level, right in the range of these levels. Actually, my true level is right at this gap fill, which we just pierced right now. And I'm so tempted, but I'm just so tempted to short this level because this is a parabolic move to the upside. If it hit the upper range today, I would take a stab at a short. And that would be a swing short. I would hold that overnight. Spotify is continuing to push. So back at Meta. So the markets are grinding up, but Meta is kind of lagging, which means there is some potential distribution in Meta, but until we see some market downside, it's likely we don't see any downside, real downside in Meta.
Pivot and the cut in interest rates, which would be, exceptionally difficult to realize if that inflation trajectory doesn't show up the way the consensus forecast has it.
I'm sitting here and I'm about to do an impression, my best impression of trying to be diplomatic. But are we all saying he's that bad at his job, Jeff, that he's got to walk this back in the next couple of weeks? I mean...
Oh, you're cruel.
I really don't understand it, Jeff. He would have had time to practice this last night and this morning. We all knew what questions would be asked. Are we seriously sitting here and saying he didn't mean what he said about financial conditions?
Well, I think it was one question. It was in the beginning. Everything else went to script, right? Everything else was cautionary, explaining the different components in terms of inflation, the lack of certainty around the wage piece, the importance of why we need to keep the pace going, slowing, but going because of their perception of what is the appropriate stance. So all of that was there. It was this one piece on financial conditions. Perhaps there's going to be a clarification. We've seen this before in other meetings where there were statements made where it wasn't clear where he was talking about short-term inflation when talking about real rates or long-term. They came back out to clarify that. So, perhaps they do. But most of what was here, and that was the market reaction at the beginning, this was sort of relatively hawkish, kind of delivered on expectations. Rates were a little bit higher. But the question on financial conditions certainly has triggered this rally.
It's a long way of not answering it, Jeff. Thank you.
Yeah,
Jeff Rosenberg.
sorry.
Nailed it, Jeff.
Thank you, Jeff. Your equity market then up 1.2% on the NASDAQ. We're up by more than 2%. The rally in the bond market, let's look at a move. Yields are lower at the front end by 11 basis points on a two-year term, 4.088% on a two-year.
So we're seeing Meta just really stuck in this little sideways range. Markets are trying to potentially consolidate to move higher, but they haven't been able to break out the high pivot from the Fed, basically after Powell ended. So this is the high pivot. We've yet to take that out. So it does favor downside price action, testing the low range of this wick until we can confirm above there. And obviously we're still short Meta. Right now we're slightly in the money on Meta. Slightly. Yields are still at the lows of the day, so is the dollar. It's a 2-6 position on Meta. So Meta's just really pulling off our level here as the SPY consolidates. We are waiting patiently for Meta to try to pull off the highs. The SPY still remains strong at the high of the chart.
Coming down today, but what would happen if we got a 3.5% unemployment rate on Friday? The bond market might completely reverse itself. So the Fed can't be as reactive to every change in the way the markets go as the markets can be, and I think Powell wanted to make that point today.
Michael McKee, thank you so much, and we'll
Thanks,
get
Mike.
further wisdom, I think, John, here in the coming days. We need to frame, John, who this guest is.
So Meta's just really consolidating here, hasn't taken out its high, as opposed to the SPY has. The S&P is pushing to make a new high right now. So it is a little bit of weakness on Meta's part. Tiny bit of weakness. Oil has bounced off the lows. S&P is pushing. S&P is pushing up now, starting to rally even more. Meta's starting to push higher. It's just following the S&P 500, making new highs. So now the S&P is still remaining at the highs of the day. Let's flip back to Meta. So the next add level on Meta is at this 154 level, 154. Spider's new high. Spiders are pushing up to 412 now. They're getting a nice big surge. A big surge on the S&P. This could be a little bit of a squeeze going on. A little bit of a squeeze occurring. Coinbase is flying. Carvana is flying.
Terminal rate is just around the corner. The big debate
So
now
the
is what
S&P
do we
is
come
still
down
pushing
to?
up near the
Where do we
high,
settle
so is
down
Meta.
CPI? Is it 4%?
Everything is
Can we
getting
get
a
that
rally
nice quick
here.
trajectory
Everything
back
is
to
in
zero
rally
without
mode.
doing too much damage? And how long is the Fed going to stay at peak? And Matt, I just wonder, is there a date on a calendar where you think that difference, that spread between this market and this Federal Reserve starts to get reconciled, resolved in one way or the other?
Yeah, I think there's two elements to this. There's the terminal rate pricing, the gap that's there, and can that possibly close? And then there's the rate cut part to it. I do think if we get stronger inflation prints over the next.
Really interesting for a short, especially when you factor in how extended the S&P is now. Meta just briefly made a new high and is pulling off that level. Apple remains strong. The S&P is now up on the market session 1.62% after being down most of the day.
Begin to cut rates this year, and that's because they are coming from such a restrictive stance from monetary policy that even as inflation comes down, they can keep real rates positive while still cutting the nominal Fed funds rate.
If it pushes up a little bit more, I want it for a short AMD. AMD is continuing to push up. Meta is seeing a little bit of distribution. The S&P still remains strong, just closing under 413 right now. Apple's at the highs, Nvidia's pushing higher. Bitcoin's at 23,591. AMD is losing a little bit of steam. So we're slightly out of the money on Meta. Let's take a look at AMD again. CVNA has pulled off the highs. But a very, very strong market move. So the S&P is pushing up yet again. Let's just see where we are on the daily chart, because this market has gone basically parabolic. And you can see we're coming up into this wide range red bar. This will be a big level for the markets. Let's pull this gap fill. So that gap was just officially filled today to the upside. And now the next big level is going to coincide with this previous sell-off. This was your credits. The Bank of Switzerland, I believe, raised rates surprisingly and spooked the market. That was that sell-off. So we're now coming up to that, and it should coincide with this little high pivot. That'll be a level, and then also your gap fill down here. We're not going to get there today, but we could in the near term, but certainly not today. Now, volume has picked up considerably. Another level we could be retracing to is this original breakdown zone on the SPY, which puts you up really at the 430 level. But we'll have to take it day by day and see what is in store. But an exceptional rally for the markets. Dollar's still at the lows of the session. AMD is seeing a little bit of weakness, and that was the market moving leader.
Is that the outcome the Fed chair wanted from this particular meeting, Tom? I think it's fair to say it probably isn't.
Yes, I agree. It was, in a way, it was almost like he was in the metaverse. I mean, you know, we don't have the metaverse within monetary policy, but I'm looking at a market reaction that screams metaverse.
Well, here's the thing, and to be fair to Jay Powell, he's trying to speak the truth, and the truth is nuanced, to a market that doesn't want nuance and doesn't want that wants a hard statement. This is what we're going to do. This is where we lean. And he's saying, you know, okay, we've got this, we've got that. And that nuance isn't playing well in a market that is looking for something definitive.
I just want him to reflect the consensus on the committee. And when he's asked straight questions like, did you discuss a pause? Just answer the question.
Very minimal. Decent volume on that 5-minute sell. But nothing out of the ordinary. And the SMH just hit major resistance. So the semis just hit major resistance. Multiple gaps were filled. Nvidia's potentially got a little bit more, but also into some major resistance. So we could see, like if I put you on the SMH chart, in terms of what I'm looking at, is this major trend line, which was just tagged as we speak. So this connects your major pivot in the summer to your breakdown zone. Retrace, just kissed it, and now you've retraced in an extended form. So semis are at resistance. Semis are at resistance. And let's see what type of price action we get. Spiders still remain very strong. We've had a big broad market rally. Meta's still pushing up. Meta has earnings after the bell, so we'll see what price action is in store on that front. Let's take a look at the US 10-year. Oops. So you can see the US 10-years back below this white trend line, its main trend, its major trend. And basically it hasn't confirmed below that yet. Gold is pushing up strong, 1952. What a move on gold. Let's flip back to Meta. Meta's trying to peak up still, heading into earnings. Meta is peaking up. So right now the SPY is just still seeing a little bit of distribution on a 10-minute basis. Volume starting to pick up. This is basically the last 13 minutes of the trading session. Will we see profit taking come in ahead of earnings? You are seeing the SPY come in a little bit harder now, but still an impressive move to the upside. S&P's coming in a little bit more now. Coincided with the SMH hitting that major resistance. You can see the SMH, AMD coming in a little bit. but Meta still remains up. Spider's coming in a little bit more now. Let's see how much downside we can actually get. But it's amazing when leading sectors hit major resistance, what happens and what transpires. And many stocks fulfilled their upside measured move just with this last little Fed rally. So as a lot of people turn bullish, there's always a possibility that markets can give all this back up tomorrow. We've seen it many times before, the volatility. But again, markets are trading at big resistance, daily resistance, and they really have to prove themselves over this next weekly close. And let I remind you, we still have massive earnings ahead, such as Apple. So let's just look at the Qs. It'll be positive if the Qs can actually close above this level. And this trend line is very tricky because you can actually have it technically here, connecting with this pivot zone on a weekly basis, this impulse breakdown bar, and these pivots. So that's probably the correct level, the most correct level. So a close above that's bullish, a close below that still means you're still technically at resistance. Markets are coming in a little bit harder now. Take a look at the S&P. Profit taking definitely is occurring. We'll see on a 10-minute basis. Nope, we did not engulf that candle, just a little bit of sell side pressure. But the volume was fairly decent on a 10-minute candle. The volume is very strong. Meta is still remaining very strong, so that's very intriguing to see ahead of earnings. And the volume on Meta has picked up substantially, which does show potential signs of distribution. Meta is starting to fall now, just a little bit more now. So the fact that you weren't able to really close above this pivot high and confirm does leave it a little bit vulnerable to retest this lower pivot. The SPY is continuing to sell. This is where we could see Meta come in a little bit harder, but to get earnings for Meta could be wild. Could be very wild. AMD has seen a nice pullback. So has Boeing. So Meta's getting bought right back up. Spiders are still seeing some sell side pressure. Just a little bit. Meta's getting bought back up. So Meta, I would add to Meta still at 154. It's risky going into earnings, but I'm still thinking the extension move being at the 200 without any real consolidation leaves it slightly vulnerable. It could pop up to about 160. There's a key trend line, a retrace. It would be a perfect retrace. And then there is a gap fill at 169 on Meta. So in terms of what my expectations are for this trade, if we pop up to, let me just isolate down this level. So yeah, there's some key levels for Meta on the larger time frame. Yeah, we basically have them here already. And it would also coincide with, yes, this pivot here. So I would add to my short at 161, 168, and I'm okay holding that overnight. As a swing trade, we are already short Meta as a swing, so I'm comfortable holding it overnight. Look at the S&P. It's starting to come in harder now. This is interesting. Let's look at the hourly chart to see what candle formation. So this will be really intriguing to see if this trend line, remember how we drew this trend line across connecting your pivots? You pierced through that by a significant margin, and now you're reversing to potentially put in a reversal signal. This is what the markets love to do. It's never ever a slam dunk in terms of it rallying up and going to continue for the next several weeks. Markets love to bait people in. I'm not saying they're going to fall much, much lower from here, but we're at resistance and we haven't seen meaningful consolidation. And most market cycles do occur, more downside occurs when rates start to soften substantially. And what are we seeing today? We're seeing rates soften despite a Fed fund rate moving higher. So it's a divergence between the Fed and economics and the bond market. And again, it shows that the Fed is probably over tightening, which means we should have a drastic fall eventually at some point to the downside in asset prices by the fact that the Fed remains to over tighten. We've already showed many examples in our previous data and analysis of tracking the last four major bubbles in basically 08, 2000, and in the 90s. We've started contracting PMIs from a deeper negative point than any of the other previous bubble territories. So that's not a positive sign for the markets. And now markets don't just go straight down, but there's certainly a lot of exuberance that has floated into the market. And really, that's why we've seen these crazy moves in some of the speculative companies. For frick's sakes, like Carvana's up more than 100% off of a bankruptcy announcement. Like, until we start to see that disappear, I think there's more downside. But impressive rally for the bulls, yet again piercing major resistance, hitting semiconductor resistance points. Nvidia is basically on the brink of hitting a key resistance, which you can argue it did today. The Dow transports have been impeccable. The dollar's made a new low in the downtrend. So lots of action has happened today. And if you look at the volume trends, let's say on the 15-minute, this last 15-minute candle has considerably picked up in volume to the sell side. Even those last 5-minute candles, to think that your 5-minute sell side candles had more volume in it than most of your rally is pretty scary. But we'll see what transpires. Yields are still falling sharply. Meta's still just off of our level. We do have earnings coming up with Meta, Aflac, Merck. So we have tons of earnings. Meta is a huge one after the bell, which is starting to come in now. Just slightly with the S&P. We'll keep Meta up on the radar since it's obviously an intriguing one. What other earnings do we have? Let me just take a quick peek. So after the bell, Novartis, that's a big one. Altria, I'm just looking for the ones that we're short. SCCO, Southern Copper, we have some exposure there. So Meta still just remains off our level. There's about 2 minutes to the close. The S&P is remaining slightly weak off the highs. So we also have Merck SCCO. So we're watching quite a few things here. Meta's the big market mover for our sectors and our stocks, but we also have Merck, Aflac, SCCO. So lots of interesting action that is set to occur after the bell. NVO is another big company. Aflac, of course. Let's see what else. Really, Meta is the big one.
All right, we do get the closing bells here in New York. This looked like it was going to be a down day, pretty much green across the stream. The Dow Jones.
Keep an eye on Meta. We're going to keep an eye on Merck. Southern Copper is soaring after the bell. Or not soaring, my apologies, but it is catching a bid. So we're just keeping an eye on Meta. Spiders are coming down. Meta's trying to uptick slightly. Spiders are slightly down. No real movement yet. Meta's trying to perk up a little bit. Just a little bit. So Meta's just slightly up after the bell. Meta's trying to pump up. Meta's pushing up. So Meta's up 1.16%. Meta's pushing up. It's up a little bit in the after hours. Meta's remaining near the highs. Meta's starting to come in a little bit here. The candle's turning ugly. Meta's coming in. Now it's up again. Oh, big jump on Meta.
Start off here with the 4Q numbers here. EPS coming in at $1.76 a share. The revenue coming in at $31.25 billion. The street was looking for $30.86 billion. So that's a beat on the revenue side. It does appear that adjusted EPS is also a beat, but I do need to check those comparisons. Here's your forecast going forward. The guidance, $26 billion to $28.5 billion. That's the revenue range for the first quarter. The street was looking on average for 27.25. So the top end of that range, certainly a beat on that metric here. The company also announcing a $40 billion boost in a share buyback authorization, maybe a reason why you're seeing the shares up about 8% right now. So an interesting bag here for a company that, of course, we should point out on the revenue side is still posting one of its worst quarters on a revenue basis, and probably, and we'll wait to look at these numbers, probably its worst year for revenue growth since it's been a public company.
Investors don't seem to care. Stock up 10% here in the after hours.
Buy back $40 billion a share.
It's amazing how that happens.
That's going to make shareholders happy, of course. It's going to be interesting to hear from the company whether we get some commentary on some of the competition. You think about TikTok, it seems all that we talk about. But again, you look at shares right now absolutely flying in after hours.
Mark Zuckerberg in the statement saying that Facebook just reached the milestone of 2 billion daily active users. I think this is a double-edged sword. 2 billion is great. That's a lot of people. But the question is, where's the growth?
Yeah,
then that's the metaverse, and that's what he says is the metaverse. He continues to say that the progress we're making in our AI discovery engine and Reels are major drivers of this.
That's the growth, metaverse.
That's why he's moving to the metaverse. That's where he sees the growth.
So there'll be more.
That's where he sees the opportunity.
So they'll get over 2 billion.
They've run out of people on the blue Facebook app.
Okay, but you know, in the real world, on Earth, there are actual real people, and at least right now, that's a finite number.
You sound like somebody who wasn't convinced by this, like every investor in Meta Platforms last year.
So do they then take those fourth quarter, Facebook daily active users, 2 billion, right, which was better than what was forecast? How do they ultimately, Katie, translate that into the metaverse? Do they ultimately?
Well, you think about the total addressable market, to Romaine's point, in the real world, that makes the total addressable market the Earth's population. So if you think about long-term...
on Meta.
There you go, but how long-term is long-term? Maybe this is premature.
Okay, so we're back to TAM, total addressable. I mean, I feel like this. I mean, what is this? Are we back in like 2012 here? I mean, at some point, I mean, we've seen this pivot that Mark Zuckerberg made that took them. Let's just be clear, took them from a double-digit revenue growth rate, and I'm talking like 40%, 30-something percent, to a negative sign. 3 straight quarters now. So what am I missing?
But don't you think that revenue growth would have happened with or without investing $10 billion in the metaverse?
So Meta's trading at 173.05. 173.05. Keep in mind that the volume is light in the after hours, so things can push farther than most people think. Really, I haven't seen any other movement in GFL, Southern Copper Corporation. Merck hasn't moved. How's that NVS doing? So it's continuing to push up. If it pierces this 175.10, I will add yet again another 4-6 position to Meta. But we've had an impeccable move to the upside here. So forward guidance could also be interesting.
Monitor it, guys. Yeah, I know exactly. Fed meeting? What Fed meeting, everybody? It's all about Meta right now.
Okay.
All right, that's a wrap. Our cross-platform coverage, Beyond the Bell, radio, TV, YouTube, and on Bloomberg Quick Take.
Investors are willing to make the same bet on the metaverse that Mark Zuckerberg is. Pleased to say, joining us right now, live on set, is Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, and a blast from the past, well, Caroline Hyde, co-host of Bloomberg Technology. And Mandeep, we love you, but I'm going to start with Caroline because she is right.
Filled on Meta 175.26 short, 175.26. That's a 4-6 position. You can 175.26 short. Meta is continuing to surge. Average on the day trade. Sorry, just give me a second.
This is a 2030s bet. This is what Mark Zuckerberg told us.
Yeah.
In the here and the now, we're looking at advertising revenue that is falling, that their prices are down on average, but they're buying back shares. That's the initial knee-jerk reaction. The long term is still whether or not they manage to build this VR future.
Well, let's talk about what this path looks like until we get to 2030, when maybe the metaverse and some of these acquisitions that they're making make a little bit more sense. What do we know about the next couple of years and what's happening and what Meta looks like? What company Meta is
continuing to push up. I wonder if Snap is being lifted. Let's take a look at Snap. Probably a sympathy play. Slightly off the lows. So we really haven't had any other movement in the market. The S&P is still off the highs. Obviously, Meta's the big winner right now. No movement in Merck. No real movement in Aflac. No real movement in Southern Copper. NVS. Can scroll through some other charts here just to see if there's anything while we await Meta. NVS. So Meta's continuing to pump up. $183.85 is the next level. 183.85. Clearly lots of strength coming back into Meta. Kramer gave the buy signal a few weeks ago. Buy Meta. Guess he was right. A little inside tip. But basically Meta is now pretty much overbought on all the major time frames. It is coming from the bedrock low, which is why it's seeing a massive, massive rally. And it has lifted most other stocks here. Apple's up. So it is continuing to push. Looking on the weekly chart, a major pivot bounce occurred at 186.02. 186.02, a major pivot bounce occurred. And it is coming up into that level. That was all the way back in 14th of March 2022. So if we just simply look on a weekly chart now, Meta is basically trading all the way up almost into this white trend line here, this upper one. And you can see it's recapturing this massive COVID breakdown trend line. Obviously the weekly 200 is still far away, But let's just put up the weekly 50. That chart is having a glitch. I'll just restart it here. Even with Meta's rally though, the SPY hasn't taken out that previous pivot high, so just shows you how weakened Meta did get. But let's change this orange to the 50. On Meta, and it's still remaining near the highs of the chart. Okay, so Meta has now had 1, 2, 3, 4, 5, 6, 7, 8 weeks, and this will be the 9th week of upside, clearly showing massive strength. Massive, massive strength. I'm going to add a little bit of Meta here, short, 180.73. So we have a 5-6 position there. 180.73. Brings our average to this 169.51. Sorry, 170.12. Well, we're pretty much going to call the stream to an end here. Meta's continuing to surge. It's extended on all metrics. It's gone parabolic. Not saying it can't go higher, which it's certainly kind of looking like it wants to. But it's into some decent resistance. We'll see if there's any more momentum push tomorrow. Basically, the next add level that I'll add is a pierce of, let me just isolate it down here. The next latest volume surge came in on this candle. So pierce of 199, which is a lot higher on Meta. But if it managed to squeeze up to here, I would look to add yet again. Until now, we'll just sit on that trade. Obviously, it was a very, very positive day for the markets after Powell spoke. You saw a little bit of whipsaw action, but net positive, the spiders did have a pretty terrific rally. From the low of the Fed meeting to the high, the spiders rallied 2.8%. They closed from the low to the high 2.05%. Even with the recent rally in Meta, you still have not been able to take out the pivot high on the SPY, but this is a pretty strong, powerful move for Meta. You likely see tech try to move higher tomorrow based off of this move, unless there's some unforeseen circumstance that occurs in the market. But so far, the bullish uptrend remains, and obviously we'll have more action in our daily analysis videos and our morning live stream. We have a lot of things to digest after the bell here. New price levels, new targets, new Fed commentary and rhetoric, and obviously digesting what the yield markets have done. So lots of analytical data that we have to analyze here moving forward. But overall, let's see what transpires. Tomorrow we also have big earnings as well as the remainder of the week. So we're not really out of the woods yet. We're only really out of the woods until the leader, Apple, starts reporting. But until that note, I'm going to bid you farewell. Impressive move if you were on the long side for Meta. But other than that, it's been a pretty good day for the bulls. So congrats to the bulls, and we'll see you on the charts and live stream tomorrow morning. Take care, everybody.